Tools for tracking burden cost per job for contractors. Burden costs are the costs that most contractors forget to track, and it's why you thought you were paying somebody 80 grand a year, but it feels like more. If you're not tracking burden costs, you are underbidding every job every time. By the end of this video, you're going to understand what burden costs are, where they fit in your job costing schedule, and how to track them so they stop disappearing in your overhead. So when we're going around and meeting with contractors, do a lot of workshops for contractor business owners, a lot of speaking engagements, and one of the most popular topics that we have is the financial topic, and particularly that around profitability, payroll, all the different elements that a contractor has to deal with. Cost of goods obviously being one of their biggest, especially if you're a luxury custom home builder and you're running up against 80% cost of goods, or if you're a big commercial contractor and you're 90% cost of goods. Basically, the majority of the project just passes right through and goes out to the other side. Well, there's a lot of things we do know about, and usually that falls under the function of cost of goods. And within this cost of goods, we tend to look at things like, and I like to put this in green and you'll understand why, the slime. And so what is this issue of the slime? Well, these are the ingredients fundamentally that go into the cocktail of your cost of goods to tell you what's in your cost of goods. And so in the slime is subcontractors, labor, material, and equipment. And really what I want to focus on is the L of this as it relates to that burden rate, because this is where most people get lost. In fact, when we're explaining the slime methodology and cost of goods, the number one question we get is around the L. They go, I get the subcontractors, I get the material, I get the equipment, but what about the labor? And one of the things that we've got in here is that silent burden cost of this labor, whether it's 1099 labor that gets caught in the cost of goods, or it's actually W-2 labor that is caught in the overhead of your business. And so I want you to think about it like this. When you're trying to put together your cost of goods, we need to identify what the slime is when we're doing good job costing. Job costing reminder is super simple. It's the contract value minus your cost of goods, and what that gives you is a gross profit. Then we want to minus out any overhead that goes with that. That gets us down to our net income, either on the business or on job by job. So we want to try to run this calculation job by job so that we can understand the profitability of that job. It gets us so much information for decision making moving forward, not just was this job profitable or not, although that's sort of the core definition of job profitability and job costing when we're looking at it. But to expand the camera out a little bit further, we're looking at cost of goods sold in these elements. So we understand subcontractors, we understand materials, we understand the equipment that goes with it. Sometimes this is a little challenging because sometimes you have your own equipment, sometimes you're renting equipment, whatever. But the L is where we get stuck. And we start to look at this because there are some contractors that have self-performing labor, meaning they're on payroll, W-2s, but we add them as a cost of goods. So they kind of go above the line and they're treated like subcontractors on the profit and loss statement, but really they're W-2s and a long-term employee. So do we put them down below? And so it leads to conundrums for the contractors. One thing I will tell you is when you're deciding on that, where to put it in your accounting, go talk to your accountant about it and make sure you're on the same page. Because more importantly than is it above the line or below the line, you just need to make sure that you do it the same way every time. That's really what we're looking for as it relates to this. Now, the burden cost is really, really important because we've got this formula here. A labor cost times the burden rate equals your actual total labor cost. That's what TLC means. And that total labor cost is what's going to inform something else for us that maybe we're not quite aware of. All right, let's deep dive on this. You ready? So I want to give you an example. If you decided you were going to hire somebody for $75,000, you're like, well, we're going to pay them $75,000. Well, in a year, and a lot of contractors look at that and go, all right, I got to figure out how to make $75,000 more dollars. Well, hold on, back up. You're not actually paying them $75,000. And I want you to ask yourself the question, wait a second, is he about to tell me I'm paying them less or more? All right, I want you to answer that question. Are you paying them less or more than $75,000? You're probably thinking, well, I feel like I'm paying them more. You're right. You're definitely paying them more. And here's what it is. It's this burden rate that comes in. What is that? I had a financial advisor out of San Antonio tell me this one time. He said, on top of everybody's base salary, I usually add a percentage of around 26%. That is not a scientific number. Again, talk to your accountant about these numbers and what this is specified for you. But usually what we've found in practice is between 25 and 30% increase on whatever the base is what we would classify as a burden rate. So every employee not only has their base salary, but they also layer on top of it payroll taxes. Then you have insurance. Then you have benefits. Then you have a variety of other things that you can start layering on top. So really, instead of paying $75,000 a year, you're actually paying more like $100,000 or $105,000 or $110,000 in order to have a $75,000 employee. That's that burden rate that we're talking about. So what you thought was your labor cost, especially when you capsulate it up here in the cost of goods, is actually more than that. And so that's why I say every time that you bid an estimated job where you just look at this number, you're actually underestimating the job because you're not accounting for the burden rate that's caught up with some of these layers down here like payroll taxes, benefits, and all the other extras that you wouldn't be paying if that person wasn't there. And so you've got to make sure you do a really good job when you're thinking about budgeting, both for job costing, but also budgeting for the business and taking that into account. So I want to give you a ratio that we encourage people to look through. Again, talk to your accountant about the specifics of this, but this is a good general ratio. 1 to 3. So for every dollar that you invest in a team member, in this case, $75,000, plus the burden costs, and so let's just put about a 25-30% tag on that. Let's just say this is $100,000 that you're paying them. For every $100,000, you need to make sure that that role generates an additional $300,000 for the $100,000 that you're going to invest. Remember, we're not running nonprofits. We're running for-profit construction companies. And in the for-profit construction companies, we want to make sure that there's a yield or a return on this investment. That's why we're doing all this job costing, to see if the job's profitable. But one of the greatest areas that sucks profitability out of the job is not accurately understanding your labor costs that's caught up in your cost of goods, subs, labor, material, and equipment. So let's go back to your job cost calculation. You might have everything accurate in the overhead expense. You might have everything accurate in the net income based on the calculation. But if you've got inaccuracies and you've missed your labor burden here, either in the cost of goods or in your overhead, if it's a W-2 employee, then it's going to mess up this number everywhere down. So you can get your contract value right, you could run all the calculations right and think you've got your net income right, but you missed a huge element of this. Think about this. If you've got a team of 10, and the average for each one of those teams of 10 is $75,000, that's $750,000. But you missed a burden rate on every single one of them of $25,000 times 10, that's another $250,000 just for a team of 10 in annual expense that you spent but did not account for in here. And so your jobs look profitable, but they're actually not. And what covers it up a lot of times is cash flow. You live under the myth to think, well, I've got cash in my bank account, so I must be making money. That's not necessarily true. And that's why we want to have multiple things working at the same time from a financial perspective. We want you to have solid balance sheets and P&L. So think of money in past, present, and future. So I'm running out of space, but I'm going to go down the corner over here. So money runs past, present, and future. And there's lines in between. The past is looking at balance sheets and P&Ls. The future is looking at budgets, pro formas, etc. But the present is looking at your actual cash that you have in the accounts. That's why we encourage contractor owners to actually subdivide their cash accounts. Have a minimum of 6. So you have account devoted to profit, devoted to operating expense, devoted to tax, devoted to capital expense, a variety of different things so that when receivables come in, instead of your mind thinking, oh my gosh, we've got $100,000. I don't want your mind to think that. I want your mind to think, oh my gosh, we've got $80,000 that we've got to pass through the cost of goods, and we have a remaining $20,000 to split in the homes of those bank accounts to get that done. That starts to accurately account for the burden rate so that as you're running healthy job costs and as you're running healthy financials, balance sheets, profit and loss statements, subdivided cash accounts, budgets, etc., you're looking past, present, and future. And now what you can start to do is run a construction company that actually runs and grows with or without you because you've set the financial foundation and the bulwarks to make sure that you have the right numbers because you're accounting for things that most contractors don't account for. Now, I know a little bit of this can be overwhelming because you're thinking, God, what else am I missing? Actually, you're in a good spot. If you go down to the link in the description below, I've got a powerful long-form training masterclass that I've done just for you, the contractor owner. And it's called How to Build Systems for Your Construction Business. I want you to go click on that link below so that you can begin to walk through and understand the macro and how your construction business runs so we can start to integrate the micro of things like job costing and labor burden rates. Now, you might also be thinking, well, this is for people, businesses with like 500 people in it? No. I'm talking to small business owners under 100 employees that own their own contracting business. This is for you. So go click on that link below and start to integrate this burden rate into your calculations so that you can be liberated from chaos to make time for the things that matter most.